So what is this thing called index investing? How is it different from me picking my own stocks? Does the approach even make sense? If those are the kind of questions that you've asked yourself, fantastic. So for the rest of this video of index investing for newbies, I'll give you the 101, but importantly cover some of the misconceptions that some people have that's not so commonly talked about. And then of course, I'll end with some tips which you can use to get started as soon as possible. So if you're ready for that, let's go! Hey guys, it's Sunman and welcome back to the show, Your Money Game, where we'll get better with saving, spending and investing. So if you were like me, my introduction to the stock market had one key prevailing belief, and that was success depends on me picking the right stock. This one central belief can lead people down two paths. The first is that they'll call themselves an investor, and that might be a value investor, it could be a growth investor as well. The second path, which is the one I took, will lead people down a trading path. So there, you'll become a trader that does different things. You could be a day trader, swing trader, long-term trader, trend trader, you name it. Talk to enough people and I guarantee you that you'll find somebody who's found success in any of those scenarios that I've just described. All I'm saying as somebody who's tried and failed in that approach is that I wish I knew about index investing from the start. Because if I did, I'd probably be retired right now. So let me start by explaining what an index is. Very simply put, an index is simply a bundle of assets that have been grouped together so that you can track it. The thing to understand is that there are as many indexes as there are the things that people want to track. So for example, an index can be used to track a very broad segment. You have trackers for countries, for the whole world. You have trackers for entire asset classes like gold, for example, real estate or bonds. And there are even geographical segments, for example, emerging markets. Or the index can be used to track even more narrow things, for example, like specific sectors like the tech sector. You can even get even more niche by tracking something within that, like maybe autonomous vehicles. Or you can track even specific style-based investing, for example, like a value-based index. But when usually people refer to index investing as an approach, they tend to refer to the broader sense that you tend to buy very large segments like the S&P 500, or maybe own the total US stock market, or perhaps even own the entire world. So why is this approach worth considering? The first and main reason that you should be considering it is that the data supports that this is the best way that an individual investor can achieve really good returns. Look, you do not have to look very far at all to find some kind of pro investor who will point to their track record and say, look, I've beaten the stock market before, many times. So therefore, you should be doing that as well. So kudos to them and power to you should you decide that that's the approach that you want to take. Just understand that in the markets, there are many ways to skin a cat. And index investing is simply one of them, which happens to be data backed. But on top of that, from a reward to effort ratio, hey, you don't really spend a lot of time to achieve some of the best results that an individual investor can get. And that's exactly the second reason why it's really worth your time. Researching the right index to pick is nowhere near as time intensive as it is to pick individual stocks. And once you do pick those indexes, it's really up to you about how involved do you really want to be. And to be honest, the approach actually advocates for you to be as little involved as possible. The third reason is that it is a cost-effective approach, and it is low cost compared to most of the unit trusts that you'll be able to get out there, and that makes a huge difference in the end result in the long term. And it's also cheaper compared to some of the robo-advisors that you'll find outside. The final reason is that index investing is very forgiving of mistakes. It's naturally diversified, so you don't run into sudden catastrophic losses, which might happen when you invest in specific companies. And on top of that, even if you notice that the index that you bought earlier isn't the best version, it's perfectly okay to swap out of it relatively easily. For example, I recently swapped out of my China ETF called KBA to a new one called CNYA, and the only penalty that I paid was a brokerage fee. But there's absolutely no penalty at all for you to click on that like and subscribe button to please the gods of YouTube. Oh, and it kind of helps my channel grow as well. So, how do you get started? It would start with you having a broker, ideally one that will have access to the US markets, and you will begin by looking for ETFs that represent the right kind of indexes. That process is called asset allocation, and I'm not going to cover it here, so you can kind of check out the link above of what I've done before about it. All I'll say is that there isn't a one absolute approach to this process, so it's actually perfectly fine to start with maybe just even 2 very simple ETFs. You could choose something like VT, which tracks the total world stock market, or if you're a believer in the US markets, you can buy something like a VTI. And if you wanted to, you could consider your second ETF to be a bond fund like BND, and that tracks the total US bond market. Now you might be asking yourself, why don't I just buy the Singapore Straits Times Index or maybe the KLCI? Isn't that index investing? I honestly believe there's nothing wrong with you including that as a part of your portfolio. The reason why is that the index investing approach is usually based off research that was done primarily on the US market, and on top of that, it just so happens that the US currently is still one of the biggest global drivers of growth. It does not mean they're going to play that role forever, but in the foreseeable future, come on, take a look around you and ask yourself how many of the things and the brands and the businesses that you use are American based. Nevertheless, my personal approach is to still have US as the base, but have diversification into different regions. For example, like me, I choose to diversify to China. So to be honest, once you buy a couple of funds, congratulations, you've already got your first portfolio set up. But that leads me naturally to the next section, which is beginning to be a bit more nuanced with your portfolio and thinking. And I want to cover some things that are not very commonly talked about. The first is that the term index investing tends to be used interchangeably with passive investing. There's actually more to this story, so let me explain. So I want you to imagine a line across a screen, and that line represents how active you are in making investment decisions. On one extreme end is pure passive investing, where maybe you buy a couple of funds and you literally do not touch it for the rest of your life. On the other extreme end of the line is active trading, where you're constantly making decisions, perhaps even on a daily basis. If you start index investing, there is nothing stopping you from going through the kind of temptations that active investors also have. So if you bought an index fund, you might be tempted to trade that index fund. And as you begin to get more experience and more comfortable, you will begin to diversify by perhaps buying different regions or buying different asset classes. Each of those decisions pushes you closer and closer towards becoming a bit more of an active investor. This isn't necessarily a bad thing, but you should understand that the theory behind index investing is to do as little as possible. The next point is that not all indexes are created equal. When you start, it's perfectly fine to go through some of the tried and true ETFs out there, but once you begin to diversify, you begin to realize that there are some ETFs that look like they track the exact same thing, but they aren't really the same once you kind of dig under the hood. For example, you'll have ETFs like EEM and VWO, both of which track emerging markets. However, they were both built with different rules. EEM has about 11% of its value in South Korea, but VWO doesn't even include South Korea in the mix. Whatever index that you choose to use to diversify, make sure you do your research to check in the underlying holdings so that it truly represents what you wanted to invest in. Oh, and of course, check for costs, especially as your account size grows. But let me leave you with a few personal tips so that you can get started quite easily. If you find yourself stressing about which broker is the best broker, which broker is the cheapest broker, don't let that hold you back too much. Because index investing is meant to be passive, you're not making that many trading decisions. You do not have to worry about optimizing too much early on. You can always switch brokers later. The next tip is that as you start building your very first index fund portfolio, you will face some level of stress. You'll be kind of anxious about which is the right index fund to pick. Don't worry too much. Like I said, start easy. 1, 2 funds, perfectly fine to get going. Only as you get larger in your account size, maybe pushing the high 5-figure mark, maybe the 6-figure mark, That's when you begin to worry about more diversification and considering brokers that allow you access to other markets like the London Stock Exchange. The reason why is that usually there are access to certain funds over there that can be more tax efficient for you. Finally, understand that index investing as an approach is all about consistency. Just keep investing month on month and don't pay any attention to all the market noise out there. So if you have any questions about index investing or any of the material that I covered before, feel free to leave it in the comments below and then I'll try and help you out. So I hope you guys found this useful, and if you did, I would really appreciate your support for my channel by clicking on that like, subscribe, as well as that bell button, because I'll be back again next Sunday with a brand new video, and I'll be covering some of the more popular index ETFs that you can consider for your portfolio. And until then, you take care and keep playing your own game.